The household savings rate in the United States has spiked amidst the pandemic, and that's as people were getting aid checks and were saving a lot of that money, realizing that a rainy day can strike at any time, as we learned to our peril this year. Our next guest is watching that trend and what is going to happen with that money. Rich Sega is Global Chief Investment Strategist at Conning, which is an institutional asset manager. Rich, thanks for being here. So as we look at that savings rate, I wonder, first of all, what's going to happen with this next round of stimulus, if indeed it does get passed, which we know there's sort of a last moment roadblock. And do people stop saving it at the same rate and start to spend it at a higher rate?
Well, happy Christmas Eve and happy 2021. And I think it will be a happy 2021, in part because of this buildup of cash that people received over the last year, and in many cases didn't have a lot of opportunity to spend it on stuff they wanted to. Couldn't go out. A lot of stuff was done online, but the real engagement in the economy was closed off to a lot of folks for a long time. And some still is. The people who are in industries that are still under extreme stress, more on the service side than on the manufacturing side, but those folks are depending on maybe a little bit more of that government help coming from the next bill. That's, as you say, a little bit up in the air right now. But I think as things do normalize, we have a lot of momentum coming back up from the depths of 2020 into the end of the year. That'll carry into 21. And as people, particularly if they can get comfortable with the vaccine and its beneficial effects, we'll start spending money again, and that'll be great for the economy.
Rich, let me push back on that too. You know, we just recently ran a Yahoo Finance Harris survey poll, and we asked people, well, if you got a new stimulus check, what would you do with it? Would you go out there and spend it willy-nilly? Would you save it? And a lot of folks that we polled or surveyed that came back and said, we're going to save that check. So really, what gives you that confidence that once that money's in hand, that the consumers will go out there and actually spend it, maybe on things that they don't necessarily need, or that they might just save it? I mean, look at the consumer confidence numbers we've been getting. People are, I would say, petrified about their current financial standing.
Oh, that's quite true. Sentiment's down, and I'm not suggesting that they would do things willy-nilly. A lot of things they need to spend money on, as has come up in a couple of your prior healthcare segments, are things that they haven't been able to do that they need. And when the stress on the healthcare system releases a little bit and allows them to come back and do regular maintenance for their physical health, that's some money that'll be spent there. Plus, I think we're just before the end of the year, we're not really over this thing yet, and there's a big election in Georgia on which a lot of the benefits that could come to the economy in 2021 hinge. There's uncertainty here, but once it gets going, I believe that money will come out. Again, not willy-nilly, but on things that people like and want, and there's people should have what they want if they can afford it.
And Rich, we have had a lot of discussions about valuations at these levels, given that there is a decent amount of optimism going into 2021. Whenever you have a discussion about valuations, stocks don't fall just because valuations are high, right? That rarely happens. And so how are you thinking about valuations as we go into next year, because they are at a historically elevated level?
Sure, and you'd be more excited about it for higher returns on investment if valuations were lower. They're not, but I don't think they're high enough to take the opportunity away, because I look more toward earnings than current valuation. And I think earnings will be supported by the economic backdrop that I spoke of going into this year.
Rich, how do you think what the earnings estimates we do see out there for the S&P 500, they're too high? I can't tell you the number of guests that we've talked to the past 2 weeks are now baking in a double-dip recession and a decline in growth in the first quarter. How much more do these estimates have to come down if that does happen?
Well, if we have a double-dip recession, which, again, there's a lot of risks out there, and I guess we could trigger one by expanding and broadening the economic lockdowns that potentially could see. But I don't think if we saw the kind of development of the momentum coming into 21 from 20 and the development of the opportunities to spend some of that money, I don't think they have to come down. A year ago, no one would, a lot of economists and forecasters out there wouldn't have thought that we'd have been in near the difficult circumstances that we are right now. But those same folks 6 months ago wouldn't have thought we'd be as well off as we are right now. So those kinds of forecasts don't trouble me very much. I like to look at the fundamentals here and look through the immediate problems into the longer term. And that looks pretty good to me.
Rich Sega, Global Chief Investment Strategist at Conning. Thanks so much for your time and happy holidays to you.
Merry Christmas, all.